All right, well, we are seeing some positive performance for North American stocks, and that record run for the S&P 500 continuing this morning. Obviously, technology has done a lot of the heavy lifting, as evidenced by the NASDAQ. Not talking about just today, obviously over the last year. My next guest has three particular things he's watching closely to determine what the mood might look like going forward. David Nelson is chief strategist at Belpointe Asset Management and one of our regular guests. David, it's great to have you back with us. Thanks for the time.
Hey, thanks for having me, John.
Let's start with the things that you're watching. Actually, we're quite busy this week with a lot of companies set to report their quarterly results. How does earnings, you think, factor into whether or not investors want to keep putting money to work in, let's say, big technology companies?
That's probably the key thing right there. That's probably number one with a bullet. You know, everybody's worried about valuations here, but expensive on its own, that's not a sell signal. You're going to need some kind of catalyst, and earnings could certainly be that. Still very early in the season, and a lot of the AI heavyweights have not reported yet. But it's going to take more than a missed number. A missed number on its own isn't going to do it. But if you saw something from like a NVIDIA or Microsoft, where they were talking about demand not being what they thought it was, or even worse, that is slowing down, yeah, that's enough to upend the rally. That's certainly number one. And
then what about central bank talk? Because in my observation, we watched the mood of the equity market improve into the tail end of 2023 on a growing belief that the economic environment was not miserable, but it had improved enough, especially on the inflation front, that you could see some rate cuts coming. And then we spent, it felt like the last few weeks debating whether or not you'd see rate cuts, you know, as soon as the spring, let's say. Fed officials, in some cases, poured cold water on that. How important is the dialogue around the Fed and interest rates to where the market goes from here?
I think it's critical, and you're right. The timing of the cut, that's been slowly pushed out. But on the other side of that, you have some like the Fed's Waller, saying that the Fed is rethinking quantitative tightening. You've got Wall Street banks like J.P. Morgan are already cutting the amount of the roll-off on the balance sheet. That could add $30 billion a month to liquidity. So even there, that's not helping the bears.
Okay. Meanwhile, one could make the argument that while everybody tries to make these predictions on where things go, it is a world that has plenty of uncertainty, and arguably it's the geopolitical themes that have played out over the last 2.5, 3 years that really factor into the things that we didn't see coming. So how closely does the geopolitical piece factor into what ultimately happens in an index like the S&P 500 this year?
I think it's the toughest to analyze. We're 2 years into a war in Ukraine. It seems to be a stalemate at this point. There are already some saying Putin is looking at Finland or Poland. If you have a NATO country involved, Article 5 is triggered, and suddenly the United States is in direct conflict with another nuclear power. Trust me, stocks aren't going to like that. And on the other side of the world, we have the war in Gaza is now spread to the Red Sea. Iranian proxies are going after shipping. Suez Canal traffic is now the lowest in years. As ships go around the Cape of Good Hope, that adds 8,000 nautical miles to the journey in about 10 days. That's real money that's going to get passed on consumers, and stocks aren't going to like that either. So all of those are very, very tough to analyze and could upend the party sooner than we hoped. And
actually, on a somewhat related note, I've been getting a lot of audience questions about the presidential election. And history is quite clear, actually. In election years, if you were just to say buy or sell, buying more often than not was a pretty good move, because historically you've seen up years versus down years during an election cycle. But we're going to see so many headlines and so much confusion and worry and angst, et cetera, et cetera. How do you think the stock market will be thinking about the presidential election?
I don't even know what to think about it. Okay. This one is too tough to game, because we've never been here before. We've never had this type of situation. This will probably be the most contested election in my lifetime. No matter who wins here, the other side is going to feel like that president is illegitimate, and it looks like the candidates are going to be, we're going to have the Trump-Biden rematch.
Okay. Now, as we navigate that uncertainty, you have some conviction around individual stocks. One name that you wanted to flag for our audience today is IBM. IBM doesn't really get a lot of love. It's certainly not part of the so-called Magnificent Seven, but it's a company that's navigated a lot of tech cycles over the year. What is it about the makeup of the business that catches your eye right now?
I will tell you flat out, I don't own this one right now. I'm late to the party. I love the recent upgrades in this stock. And John, I've been writing negatively about IBM for most of the last decade, and for good reason. Under Ginny Rometty and the gang that couldn't shoot straight, all they did was buy back stock to prop up CEO pay at the expense of revenue growth. Now that seems to be gone, and under new leadership, they've got revenue growth. It's not a lot. Single digits. Earnings growth is back as well. 7% free cash flow yield and a near 4% dividend. And the fact that it's breaking out to a multi-year high, that's pretty interesting to me. I'm looking for an entry point.